So GameStop was up almost 2,000% at one point since the beginning of 2021. What's happening? With all the drama and money flying around GameStop, I really wanted to try and break down what's happening and try to take an objective stance on everything. Although honestly, the more I read, the more I watch, the more frustrated I get, and you'll definitely be able to tell throughout these videos. Note, I'm not a financial advisor. This is for entertainment and educational purposes only. Please do your own due diligence before investing or trading. So there's a lot of financial jargon I'm going to explain, and I'm going to try and put up stuff on screen that will help explain. So please comment if you have any questions about anything I say or want to start a productive debate, or if you just want to say hi honestly, and make sure to like and subscribe for all things money and finance. So, long story short, billionaire hedge fund managers took a massive short position in GameStop. It's backfiring and they're blaming the dumb retail investor. We're going to need to wind this back a little bit, and in this video I'm going to try and explain a few key concepts that were in place that allowed this whole thing to unfold. Firstly, what does it mean to short a stock? Traditionally, the goal with stocks is obviously to buy low and sell high, although plenty of people get this backwards and they buy high and sell low. Very important distinction there. And you profit the difference between the prices and you lose the difference between the prices if it goes down. In this traditional way of investing or trading, you are betting on and benefiting from an increase in the stock price. In this case, the maximum risk is 100% of your investment. So for example, if you bought a stock for $10 and it goes to $100, you just made $90 off your $10 investment. However, if the $10 stock goes to zero, you lose $10, and that's your maximum risk. So your maximum risk again is 100%. Conversely, money can also be made when stocks go down, and this is called shorting. The premise of shorting a stock is that you first sell high, then buy low. It's like traditional trading or investing, but backwards. In order to sell short, the investor sells shares that they don't own, and they do so by borrowing them from their broker. In the event that the stock price falls, they can later cover or buy back the stock at a discount and profit the amount that the stock dropped by. That was kind of a lot, so let's just do a quick example. Let's take the same $10 stock. If I short this $10 stock and it goes to zero, I make the $10 that it dropped by. However, if this stock goes to $100, I lose $90 because the stock went up $90. Note that the profit loss is kind of backwards to the traditional route. So in this case, your profit is capped at $10 because a stock cannot go negative, but your loss is theoretically infinite. If this $10 stock went to $1 million, you would lose almost $1 million. Another really important thing in this whole equation is something called margin requirement. I'm going to use and explain this picture from Investopedia, and it explains it really well. It's a lot, but please bear with me. It should help make things more clear. So when you short or borrow a stock, your broker has what's called an initial margin requirement. In this example, the initial margin requirement is 50%. So let's consider this example where shorting 1,000 shares of a $50 stock. This means that the short sale value is $50,000. 50% of $50,000 is $25,000, and $25,000 plus $50,000 is $75,000. This is what's called your total margin requirement. This means that your account must maintain an overall account value of $75,000 or more, whether it be in cash or securities. So let's say you put in the 25 grand to meet the requirement. Now let's observe what happens as the stock being shorted rises in value. So this is bad for the short sellers. If the stock price increases to $55 a share, your short sale value is now $55,000. Now something called maintenance margin kicks in, and this is a little bit different than your initial margin requirement, and in this case it's 30%. This means that the total account value must be greater than or equal to the short sale value plus 30% of that value. So if the stock price is $55 and your short sale value is $55,000, 30% of $55,000 is $16,500, and adding these two things together gives you a total margin requirement of $71,500. I know it's a lot of math, but please try and stick with me. In this case, you're good. Your account is worth more than $71,500, so you don't need to do anything at this point. What if things get worse? What if the stock price increases to $60 a share? At this point, the short sale value is $60,000. 30% of $60,000 is $18,000, and these added together is a total margin requirement of $78,000. Now your account isn't worth $78,000, so you're going to get what's called a margin call from your broker. In this case, they're going to ask you to immediately deposit $3,000 to maintain the total margin requirement, and if you can't do this, they can and will immediately liquidate positions in your account to A, lower risk for themselves, and B, maintain the margin requirement for you. And in the third row, you just see this gets worse. You'll get a margin call for $22,500. Now, what can happen if a lot of people short a stock is if the price rises quickly or even sometimes just a little bit, shorts are forced to cover, which remember means buying back the shares at the higher current market price in this case. So what drives the stock price? It's the volume of buyers and sellers. It's supply and demand in real life. Shorts cover their position by buying, which pushes the price up, which might cause more short sellers to have have to buy to cover their position, which pushes the price up, which can you see a loop happening here? And if this happens over and over and over, it can lead to something called a short squeeze, where shorts are literally being squeezed out of their position. Let's take a quick look at this example from 2008 for Volkswagen. Porsche bought so many shares of Volkswagen, it caused the price to go up, and it caused short sellers to buy, which caused the price to go higher, which means more short sellers had to cover, etc. And it caused short sellers to lose tens of billions of dollars in a couple days. Now that I've covered the background for this situation, in the next video, let's take a deeper dive as to how this plays into what's happening right now with GameStop. And make sure to subscribe for more videos on financial news, investing, trading, and financial education. See you soon.